Hi, everyone. Thank you for joining us over your lunch hour today for another one of our WESC webinars. My name is Ali Ramsey. I am WESC's Executive Assistant and Communications Coordinator, and we're so happy to have you here today. Our topic today is valuing your business, and it's presented by Megan Mistry of BDO Debt Solutions. So if you have any questions for Megan at all, please put them in the Q&A box. There's also a chat box. If you can put all your questions in the Q&A box, that would be great. But if you'd like to introduce yourself, tell us a little bit about yourself, what your business is, you can put that into the the chat box. And as always, this webinar is going to be recorded and it will be available for on-demand viewing tomorrow. You will receive a link through your email. And with that, I'm going to introduce you to Megan. And I'm going to stop sharing my screen here. So Megan, you can take it away.
Thank you, Ali. Hi, everyone. I'm just going to share my screen here. Just to start off, so happy to be here to talk to you all about business valuations. So like Ali said, please feel free to ask me questions at any time throughout the presentation. Okay. Can everyone see my screen all right?
Yes, it looks good.
Okay, thanks, Ali. Okay, so starting off, so I'm here to talk to you today all about valuing your business. The agenda for today, so first and foremost, we'll start off with really what a business valuation is, then move to why it's important to get one done and why you might need one done, and then really what the process looks like. I know for a lot of you, if it's the first time getting a valuation done, the process can seem a little intimidating. We try to streamline it and make it as simple as possible. After that, I'll move into a little bit more about the technical aspects behind valuations. So really the three main ways to value companies, the three main approaches that we use. And then I know a lot of you might have, companies in their earlier stages, more startup or scale up type companies. So I'll talk a little bit about the intricacies and specificities with valuing those earlier stage type businesses. And then since we're all in this uncertain time right now with COVID-19, I'll touch a little bit about, what we're really seeing in the market in terms of how the pandemic has impacted valuations. Okay, so just a little bit about myself. I'm a senior manager in BDO's Valuation Group. I'm located in Calgary right now. I really moved to Calgary only a couple of years ago and spent most of my life in Toronto before that. In terms of industries, I have a lot of experience and I specialize in more that early stage, high tech type industry. So biotech or information tech, SaaS is very popular. Both in the earlier stages and mature type software companies. Okay, so a business valuation is a formal opinion on the value of your business, and it's prepared by an independent valuations expert. The independent aspect is super important. As a business owner, you're really, stuck in the details of your business like you should be. But really for an owner, their business is their baby, and I'm sure you can relate to that. So to kind of take a step back and look at your business from an independent perspective and have or engage an independent valuator to put a value or worth on your business is super important. And giving that formal opinion and having that formal opinion by an independent third party really puts a lot more credibility on the valuation you're putting forward. Really depending on the purpose. So if it's a transaction related purpose, a potential purchaser is going to value an independent opinion on value a lot more than something prepared by somebody who, obviously has some conflicts of interest there. A business valuation, so it focuses on the fair market value of the company as a whole, and we consider current market conditions at the valuation date. So when we look at a business and step back and value it, we're looking at the value of 100% of the shares of the business. So really the business in its entirety. We can do valuations on specific divisions, and we have been engaged to at certain times, but really the risk profile is very different if you parse out or carve out your business into separate operating divisions versus looking at it on a whole. And market conditions are super important. So if a business, has the same financial results or is generating the same cash flows at the current date versus 10 years ago, you still will have vastly different valuations just given the changes in the market. The third point, so evaluation, it's really more of an art than a science. It's not so black and white as just, taking your recent last 12 months earnings and slapping a multiple onto that and having that as your value. There's a lot more judgment or assumptions that come into play, which makes the whole exercise kind of subjective and really susceptible to professional judgment. What evaluation is not, and we hear this a lot, oftentimes, especially for transaction-related purposes, we'll provide evaluation, and the client will be getting, you'll be getting a bunch of letters of intent or expressions of interest, and at really different prices from the valuation that we put forward. It's really important to note that evaluation is done on a very hypothetical or notional basis. So we're really taking a step back and thinking about the worth of your business from the perspective of a general pool of purchasers. A sales price, or when you expose your business to market, you'll get a bunch of different prices, and a variety of factors can come into play that will dictate that price. And it really doesn't just depend on your business, it depends on the purchaser or the potential buyer of your business. So for example, things like negotiating abilities. Negotiations play a huge part in coming up with an ultimate sales price, which evaluation wouldn't take into account. Another factor is if you're looking at strategic buyers of your business. They might have, a way to amalgamate your business into theirs and obtain synergies from that purchase. So if you compare a strategic buyer to somebody more like a financial buyer, you're going to have vastly different sales prices or prices that they're willing to pay for your business. So really, evaluation, we're not exposing your business to the market. It's in a very notional or hypothetical sense. The second point, so it's not an appraisal of real estate or equipment or any sort of hard asset. We're looking at the value of a business as a whole, including all of like the intangible aspects of your business and goodwill. We're not hard asset appraisers. Typically, if your business has a lot of real estate in it or a significant amount of equipment, we would ask that you hire an independent hard asset appraiser or a real estate appraiser to get that value, and then we'll incorporate that into our valuation. The third point is super important because a lot of times individuals would assume that your valuation needs to be disclosed to either the CRA or another party. It doesn't. It depends on the purpose. So if you are doing a valuation for tax planning, which I'll go through why you might need one in a later slide, then yes, it will be disclosed to the CRA. But if you're selling your business, there are a lot of things that we ask you in terms of, well, what are you putting that's personal in nature throughout your business? What can we adjust for to help maximize value? And a lot of times we get, well, are the tax authorities going to come after me because we're making all these adjustments and recording all of our personal items in there? And no, because if you're doing a valuation for transaction purposes, there's no necessity to disclose that to the CRA. Similarly, if you're doing a valuation for transaction purposes, you don't have to disclose that to the other party or a potential buyer. It's at your discretion. So if you want to, you can, but there's no need to, and you're not required to. So why is evaluation important? And there are a few different reasons that we have clients coming to us to get valuations. One of the more common ones is for tax. And this is really necessitated out of compliance purposes. So there are a few different tax reasons why you might engage an independent advisor. So say you have a business and you wanted to undergo an estate freeze or reorganize your corporate structure. It's really common that in cases that you need an estate freeze, you need to set your fair market value of the shares that you're planning on freezing. So that's when you would come to us to get an independent opinion on value. And really that valuation is the first step in adequate tax planning. It's definitely beneficial because if you put out a fair market value and it's not supported with an independent opinion, the CRA could come and question the value that you've kind of taken the freeze at. So in those cases, if the CRA does come back to you to have that independent third party formal opinion on value, we'll give you the adequate support that you need. The second case is for stock option issuances. So this is really common with earlier stage businesses where you're going to compensate your employees with some sort of stock options. It's super important to set your exercise price of the options that you're giving to employees, or the strike price, at fair market value. If you set it to in the money, so if you set your exercise price below fair market value of the company at the time that you're granting your options, the employee has adverse tax consequences. So they can be taxed higher for the benefit that they're getting when they do exercise those options. So again, super important to hire an independent valuator if you are issuing stock options to get that strike price at fair market value, or give you an idea of what fair market value is at the time of grant. The third item, so if you have a company that's part of a larger organizational structure, and say you have developed IP or developed proprietary tech in one of those entities, and you wish to transfer that IP between different entities, that also must be done at fair market value. So again, to engage an independent valuator will provide the CRA with that support behind the fair market value that you choose to transact at. So those reasons are really compliance. The next two are for more transaction-related mandates. And really it's necessitated not out of compliance, but the benefit of proper. As a business owner, we really don't like to see valuations needed when you're forced to sell. So when you're at a point in time where you have reasons that you need to sell your business, like death of a shareholder or divorce, or maybe profits have declined, that you're in the situation where you have a forced sale or bankruptcy. It's really hard, and it kind of takes away a lot of the benefit of getting a valuation done, because really when you approach us to do a valuation, we're not only going to give you an idea of the worth of your company, but we're going to highlight some issues that we see in the company that you could change to really improve its value when you do enter market. So to have a bit of leeway and grace period before selling and getting your valuation is really, really important. I like to think of this, and maybe you've heard the term like window dressing your business. It's kind of common to selling a house. If you were to try to sell your house, you really want to stage it and fix all the issues before you enter that sales process. The same thing with a business. You really want to identify what issues you have in the business, what are the warts and hairs that you can tweak and tailor, so when you are ready to sell, you present your business in the best light. And that's really what evaluation can help you do. So not only set the worth of your business, but highlight those areas. So when you do sell maybe 3 to 5 years down the road, you are presenting your business in the best possible light. The next one is financing or raising capital. So obviously for early stage companies, this is huge. Access to capital is crucial for the success of a business. And an independent valuation really allows the early stage company owners to raise financing at appropriate multiples. It's really tricky with early stage businesses because evaluation is so subjective at that point in time. But trying to come up with as accurate or as reasonable evaluation as possible when you do enter the market to raise capital is super, super important. In the next slide, I'll give you some examples why. So with funding, and in a context of early stage, like I said, it's so subjective, and you just have a lot of assumptions at play. So to get a completely accurate valuation is almost impossible because of all the subjectivity. But what we want is really a fair or reasonable value. If your value is set too low when you go into funding, obviously it's not great for an owner. You're going to get too little consideration for the amount of equity that you're giving up. Or on the flip side, you're going to give up too much equity for the consideration that you're getting. So obviously it's not a great thing to set your valuation too low or lower than reasonable. From an investor's perspective, and I'll go through, and you'll see a lot in these slides, I'll touch on the perspective of a buyer. And why this is super important is, like I said, your business is your baby, so it's hard to kind of step out and look at your business from a third-party perspective. But when we look at valuations of businesses and try to value businesses, we're looking at it from a purchaser's or an investor's point of view. It's really, what would they pay for your business? What issues do they see? What risks do they see? And what opportunities do they see? And that really dictates the value or the price that ultimately they're going to give you. So if your valuation is too low, that's generally fine from an investor's perspective. I mean, they're getting a good deal. But the most important thing really in an early stage company is the entrepreneur. It's the owner, and that owner makes all of the difference in taking the business to the next level and generating future cash flow. So if your valuation's too low, from an investor's point of view, they don't want to take too much equity that it removes, your skin in the game. And they really want to align, motivations and incentives. So that can be very detrimental if they take away too much equity and the entrepreneur, which is the biggest asset of the business, is no longer motivated. If your valuation is set too high, so you might think this is great to have a really high valuation going into funding, but it can make it really difficult to get subsequent or secure subsequent financing rounds. So especially with early stage companies, we see, multiple subsequent financing rounds. One financing might be enough to get you to your first milestone, but then you're going to need additional capital to take your business to the next level. So when you set your valuation really high at the get-go, it really sets the floor for future valuations. If it's not achievable in financing, you can't really set your valuation much lower than you started with. It's upsetting to your first set of investors because now they're diluting their ownership interest and they're diluting their capital. And you're offering additional investors who might have come into play later in the game, a worse off kind of deal. So even like if you set your valuation too high and you get initial investors coming in, depending on what round you offer them, if your subsequent financing rounds are done at lower valuations than your first one, they might choose to block it because again, their ownership interest is getting diluted. So you always want to set it at enough of like a reasonable amount that you can keep getting higher and higher and actually achieving the growth to support a higher and higher valuation. From an investor's perspective, obviously a valuation that's too high is a terrible thing for them. I mean, they're going to give up too much consideration for the equity that they're going to receive, or on the flip side, they're receiving too little equity for the amount of consideration that they're giving. Are there any questions so far? Okay. So what does the process look like? And like I said, it can be intimidating if it's your first time undergoing evaluation, but we try to make it as simple as possible. So generally it starts with the numbers. I mean, the financial statements or financial results are always going to be our starting point. More of an art than a science. It quickly changes to becoming less to do about numbers and math, and more to do with the qualitative aspects of your business. So we'll generally hold a bunch of meetings and discussions with you and management to understand the business and then understand both the risks of the business and the opportunities that you have going forward. The numbers flow into a set of schedules. We'll walk through the schedules and hold meetings to walk through the schedules with you, address any questions you have on those. And once we're all good with the numbers, we move to providing a report component. What the report component is it's really going over the methodologies, assumptions, giving really the schedule some context behind them. And then we'll sit down, review that together, or hold a call to review that together. Answer any questions you have on the draft report, and then issue a final report. The whole process, and it depends on the client, it depends on the industry or the type of business, but generally the process takes around 4 to 6 weeks, again, depending on timeliness of information flow and different factors, but generally you can expect anywhere between a month to 6 weeks. So what work typically occurs? Financial statements are the basis of anything, so it will start with a review of your historical statements, and then as well as any projections you have. It also includes, like I said, an assessment of risks and opportunities facing the business, and a review of current market conditions for the target industry. Market conditions are huge. We look at both companies and what they're trading at in the market, as well as recent transactions to gauge really the reasonability of our value conclusion. So market is a huge factor on our valuation, and it really flows into what multiples we select, and I'll talk a little bit more about multiples and discount rates, but it does have a big impact on how we look at the business in terms of risk and how we look at what a potential purchaser would value the business at. Okay, so Valuations 101. There are two valuation terms that we typically use. And if you've got an evaluation, then you'll likely have seen both of these terms. So the first one is enterprise value, and the second one is equity value. So what enterprise value is, so say you have a business and it holds a bunch of marketable securities or investments, for example. Those investments aren't really needed to generate cash flows of the business going forward. So theoretically, you could think of those investments like you could strip them out, take the cash, and keep running your business as is. What enterprise value is meant to show is really just the value of the operations of the business. So it doesn't include those marketable securities. It doesn't include any assets that aren't needed to operate the business. Equity value, on the other hand, is the value of 100% of the shares of your business. So it will include any non-operating, or we call them redundant assets, like those marketable securities. It's really the value that if you're selling 100% of the shares of your business, that's the value you're going to get. So with all those non-operating assets in there, with any debt in there that you haven't kind of taken out or stripped out yet. So here's a build-up of what the components of value would be. So equity value and enterprise value, you see the difference, like I mentioned, are those redundant or non-operating assets. So things like investments, like I mentioned, or if you hold a piece of real estate that you don't need to operate the business out of, if you hold a parcel of vacant land, or certain vehicles that are for personal use and not for business use. Enterprise value can be thought of as built up from your net asset base, so your tangible hard assets of the business. And then as you gain or get or generate cash flows from the business, you're generating now a return on that asset base. So that return feeds itself into the value of things like identifiable intangibles. So think like brand or trade name that you've built over time for your business, maybe relationships that you have with customers, maybe a piece of IP or proprietary tech that you've internally generated. So those would be examples of intangibles that are additive to the value of your business. And then goodwill is one of those residual bucket items to say, okay, well, you've been running your business for X period of time, you're generating positive cash flow. Goodwill is accretive to the value of your business. So those three elements combined would get you the value of the operations of your business, which is your enterprise value. Okay, so moving on to the three main ways to value your company. So we have three different methodologies. We might use a selection of them. We might use all three of them. It really depends on the business. So the three main ones, the first one is an asset-based valuation, the second is valuation, third is income-based valuation. So what this is it really calculates the value of your business based solely on the value of your net assets without consideration to future earnings capacity. So you can think of cases where the asset value of your business is really more related to its value than income earning potential. So things like holding companies, which you might hold an investment in an operating sub, or you might hold a lot of real estate, which might dictate the value more closely than future income or future cash flows. So that's when we would turn to an asset-based valuation. The other time we would turn to an asset-based valuation is if you are not generating income or have historically been in a loss position and are not expecting to generate any income. So in those cases, we say, well, the return that you're getting on your assets isn't sufficient to cover that asset base. So the lowest value your business can be are the assets of your business. You can't have a value that's lower than what the hard assets of your business are worth. So that's another reason if you're generating losses and you're not generating return on those assets, we would look at an asset-based valuation approach. With early stage companies, we often do employ an asset-based valuation, not as a primary method, but as either a secondary method or a sanity check on our first or primary method. With early stage companies, we use an asset-based valuation approach to set the floor. So like I said, it's going to be the minimum value your company is worth. But again, it could undervalue your company, especially in early stages, given that it doesn't consider any future income capacity or earnings capacity. And it doesn't also capture the value of any internally generated intangibles. If you think back to the buildup of the value of a business, your enterprise value is comprised of your hard assets, your net tangibles, plus any intangibles and goodwill. The only time we're going to attribute value to intangibles and goodwill is if we value your business on an income-based approach, which I'll talk about later. So your asset base is always going to be the floor. It's always going to be your minimum value. It's helpful for us to calibrate this amount or actually consider it because it does give us an idea of what that floor is. And say you are very pre-revenue in your business, you're not generating any income, you're not generating revenue, you're far from commercialization. That's really what we would fall back on if you don't have, a set of projections that are somewhat achievable or that you can gauge. To offset, the possible understatement of value on an asset-based approach, we do in practice consider giving credit to things like startup expenses that you might not have capitalized on the balance sheet, or internally generated software or IP that you might have, expended some cost into, but haven't reported that anywhere. So we do ask about those things and do add it to our cost approach in practice or our asset-based approach in practice. Okay, the second approach is called a market-based valuation approach. Oftentimes, this will never be the primary approach that we use to value your company, but we will almost always consider a market-based valuation approach just as a sanity or reasonability check on our final conclusion. So what a market-based valuation approach is it's really comparing your company to similar businesses or what we call guideline companies in the public space, because we have data in the public space, or companies that might have been recently sold in private transactions. So there are two elements of a market-based valuation. One would be looking at public comparable companies, so companies that are actively traded on the public market. And we look to those companies to see what they're trading at. So if you know their market cap, we generate or determine their enterprise value based on that market cap, and then compare it to their EBITDA or revenue levels. EBITDA being earnings before interest, taxes, and depreciation. So it gives us an idea of what those public companies are trading at, that we can really say, okay, well, here are public companies in a similar industry and similar space. How is your valuation or the valuation that we're providing you measuring up to those trading multiples? The other thing that we look at are comparable transactions. This one at times can be very helpful if we do find something that's highly comparable, although it is rare to find a transaction that's purely comparable to your company or the subject company. And again, what transactions we're looking at, well, what did they transact at? What were these companies sold at? How much revenue or EBITDA were they generating? And what are the implied multiples on those transactions? So you'll hear the term multiples a lot, and that's what that represents, is your enterprise value to revenue or your enterprise value to EBITDA. When we look at public multiples or even transaction multiples, it almost often warrants a discount when we compare it to your company or a private company. And that discount is really due to the fact that public companies are much larger in size, they're much larger in scale or more diversified. They've either had significant growth in the past or are projecting a lot more growth. And then liquidity is huge. So public companies obviously have much more liquidity and much more exit options than a private company. So when we compare those multiples that we're seeing in the public space, we often take 30 to 50% of it and apply that multiple as a sanity check to what we're coming up with in a private valuation. For early stage companies, really a market approach, it's very difficult to find purely comparable transactions or purely comparable companies, just because of the nature of startup companies. You'd have, your own proprietary tech or something very unique about it, that it's super difficult to find something purely comparable. Additionally, if you're not at the stage where you're generating revenue yet, so you're pre-revenue or your pre-EBITDA levels, like compare your multiple to a multiple of a public company generating income. A really important thing to mention is that if you are a tech or a high-tech company, your multiples are going to be on revenue and not on EBITDA, which is super advantageous, because if you do have proprietary tech in place, it might be a while till you start generating positive cash flows. So to be able to trade on multiples of revenue is so advantageous to hiking up your value. And we've seen it with companies that have IPO'd or been taken public recently. They might not even be cash flow positive, yet they're probably $1 million businesses are trading at huge multiples on revenue. The last valuation approach we use is an income-based valuation approach. And this one is probably the most common of the ones that we use. So there are two different income-based valuation approaches we would consider. The first one being discounted cash flow, which we'll talk about now. And then the second one is called capitalized cash flow approach. The difference between the two is that when you're looking at a discounted cash flow approach, you're looking at future projections. Whereas when you're looking at a capitalized cash flow approach, you're looking at your historic results. The choice or the deciding factor between the two approaches is really what you expect from the business going forward. So if you expect your historical results to be very representative of your future results, we would use a capitalized cash flow method. But if you expect a lot of growth in your business and your history or your historical track record doesn't really lend itself well to showing that growth or the positive attributes that you expect going forward, we would use a discounted cash flow approach. So with a startup company or early stage companies, discounted cash flow is going to be your method of choice, just because you don't have that track record of profitability. So there are two components or major components to a discounted cash flow approach. The first one is your forecast. So really, a forecast is super important for this approach. A well thought out forecast can be the difference or can mean the difference between getting a valuation right and getting it completely off. The second component would be the discount rate. So you have to kind of think of those things working together or kind of working in opposite directions. So the more aggressive or optimistic your projections are, the higher the discount rate will be. And ultimately, with a higher discount rate, when you discount all of those future cash flows back to present value, you're going to end up with a lower result than if you were to discount those future cash flows back with a lower discount rate. So really that discount rate, it's there to reflect all the risks of achievement of those future cash flows. And if you think of it from the perspective of an investor, it's the rate of return that they require to compensate them for the time value and risk inherent in that investment. With early stage companies, developing projections is probably one of the more tricky things to do. So we try to break it out and help you through it by segmenting it into really three aspects of revenue. So the total addressable market, and I'm sure you've probably heard these terms before, TAM is really the total market demand. And then the serviceable addressable market, SAM, would be the part or portion of that total demand that your product or service will help service. And then the serviceable obtainable market, or SOM, will be the portion of that addressable market or the serviceable addressable market that you think you can capture. And really breaking down your revenue projections into those buckets will show that you've thought out your projections and thought about, the different drivers and the different, total demand aspects or market demand. And it provides a lot more comfort to an investor or a third party going in and kind of validating those projections. But I know when you're early stage, it's super difficult to try to come up with those. That's why we try to, look at demand or something a bit more black and white than just having straight revenue figures that are kind of pulled out of thin air. The discount rate, again, with early stage companies, because there's so much risk involved in the projections, and we see things that are looking like, you probably heard the term hockey stick projections, where it starts out kind of like flat because you have no revenue or no income, and then you really skyrocket in terms of what you expect going up from the valuation date. So because there's so much risk in that, like you haven't proven that you can generate that cash flow or that amount of revenue, the discount rate is super high. The higher the discount rate, the higher the risk, or the more risk that it reflects. So with startup or early stage companies, we typically use discount rates between 30 to 50, 60%. And that's very normal for us to use. And that's a lot higher than you would see being used for a mature business, because a mature business would have more of a stable track record and maybe not project so much growth versus a startup that's very high risk. Okay, the second income-based valuation approach, like I mentioned, is that capitalized cash flow approach. And really, this is used for mature businesses when you expect your historic financial results to be very representative of what you would anticipate going forward. So what this valuation approach does is it looks at your historic results in terms of your historic revenue levels and your historic earnings levels, and then tries to adjust for anything that might be discretionary in nature, or non-business related or personal, or one-time items. And we call those normalization adjustments. So really the point here is to think of it like a purchaser is stepping in, or a third party stepping into your business to run it. They wouldn't need to expend those personal items, or they wouldn't really necessarily expend those discretionary items. And then when we're thinking about a stable level of cash flow going forward, one-time events or one-time expenses add noise to that. So we're really trying to get to an earnings or cash flow level that we think is sustainable on a go-forward basis. And we're drawing that from normalized historical results. To that selected, maintainable, or normalized level of cash flow, we're going to apply what we call a capitalization multiple. And really what that is, it's the inverse of a discount rate. So it's pretty much the same thing, just working the opposite way as a multiple. And what it does is it reflects the risks of achievement of the cash flows, and again, interpreted as a rate of return that's required by investors to compensate them for the risks of that investment. With a capitalized cash flow, we're looking at a lot less risk involved because we're using historical results as a proxy for the future. So those historical results have been proven. You have the track record there. So the capitalization rate or multiple is going to be a lot higher. So a bigger multiple means more value than what you would normally see with a discounted cash flow approach. Thinking of it a different way, your discount rate for a capitalized cash flow approach would be much lower, so less risk involved than what we would use for the discounted cash flow approach. Are there any questions so far? Okay, so now I'll move to talk a little bit about early stage or high tech valuations. I've kind of grouped them into one because tech usually follows the same sort of growth pattern as an early stage business, meaning very high growth going forward. Early stage valuations are, like I said, a lot more subjective than valuations of more mature companies. And the earlier the stage is, the more we would tend to look at more qualitative factors versus financials or quantitative factors, especially given the fact that you might not have a lot of financials in place. You would have just started your business, you don't have a good track record of performance, and really it's all dependent on the future. So we've turned to look at 4 main factors, which I've outlined here. So management, market, financials, and stage. And you'll see as I go through each of those factors, it's a lot more qualitative and a lot more judgmental than just looking at the black and white numbers. Okay, so with management team, this is probably one of the most important areas of a business that an investor will look at. So a management team with a strong entrepreneurial track record, they offer much less risk for potential investors than somebody very new to the game. Even the best ideas can fail without the right leaders to execute upon them. I used to be, so BDO, we partner with this angel investor network in Toronto called Maple Leaf Angels. So I used to sit in their office hours and listen to pitches by business owners wanting to raise capital, kind of like Dragon's Den, except a little less intense. But a common phrase they used to say is really, they're looking to invest in the jockey, not the horse. And really what that means is you can have, a good product, but unless you have great people to take that product somewhere, or a good owner or an entrepreneur to drive that product forward, it won't really result or translate to good returns. So with an investor, they're really looking at management and looking at the owner to see, okay, well, is that the right person to take this product to the next level and to help me get a return on my investment? So again, looking at the team, much more so than looking at the product, although both matter, but the right person will do a lot more for the company. Again, investor considerations and throwing them out there because it's really useful for business owners to think about their business from the shoes of a potential purchaser or a provider of capital. So investor considerations regarding your management team. So what's the entrepreneur's background? Does the assembled team have the skill set required to meet its targeted milestones, or are there any gaps in the workforce? This is super important, and I've seen it before where you have projections and you might have really lofty sales goals once your product's being commercialized, but really you might not have the team in place to get you there. So a really common example is you started your business, you have a really strong, say, tech background, for example, you've developed your product, and then you're expecting to acquire all these customers in the future. The investor's next question is going to be, well, do you have a sales team in place to help you get there? Do you have the personnel that can help you get to the next level? Without that team, you might not get there. And that's what we mean when we say, are there gaps in the workforce? Because obviously you need the right people to take you to achieve those different growth milestones. So that's a big thing, and that's something where we look at early stage companies and we'll look at the projections and we'll help you identify where you might be missing some expenses. Maybe it's selling and marketing, maybe it's R&D. So certain things we'll pick up and we'll bring to your attention so that you can really develop projections that make the most sense and that look the most reasonable to an outside party. Okay, the next factor would be market. And when I say market, I really mean, well, what's the size of the market you're trying to target, and how trendy or hot is that market? So intuitively, so a larger total addressable market or larger demand results in a greater opportunity for the company and ultimately for the investor going forward. If you take, the same portion of a smaller market, you might not be able to generate as good of a return as if you have, the same share of a very large and growing market. Also, valuations are really heavily influenced on what's hot or trendy. We've seen it in things like the cannabis space is a great example. The cannabis had a bit of volatility recently, but cannabis is one of those where the multiples are super high, and same with tech. We're looking at really high multiples because those are the industries that are on trend right now. Those are what industries people are trying to buy into. And it does have a pretty significant impact on valuations and really the discount rate or the multiple that we're going to use in our valuations. So some investor considerations. So is the market size large enough for the business to be feasible? Do the trends indicate that the market size will continue expanding? Obviously, for an investor, you want to be part of a market that is growing and expanding versus one, say, like publishing or newspaper or hard print that is declining, because it really leaves you uncertain as to if you can exit for one and what the returns will be. And then speaking of exit, an investor will always consider if the business exists in a highly acquisitive market, and is there potential for the subject company to be acquired by a larger market participant. So from an investor standpoint, they are always looking to get return on their investment. So a market that is highly acquisitive means much more exit potential for them, and much more flexibility to exit when they want to. So that's always a good thing, and that's always a positive to bring up if you are in an industry or operating a company in an industry that's very highly acquisitive and there's a lot of M&A traction. Okay, the next point or next factor to consider is your financial information. We can't stay too far away from financials at any time because we are trying to provide you with a number or a value. But really with early stage companies, it's less based on historical financials and more based on the projections. So a well thought out projection, it first signals a management team that's realistic, that's goal oriented, and that has a really good understanding of the market. When we look at projections, or when investors will look at your projections, and these points are really helpful to consider too when you develop projections. So what are the key drivers of revenue and earnings growth, and how have they been incorporated into the projections? What's the quality of revenue? So is revenue recurring, or do new customers need to be acquired every year? That's a really important one for tech businesses. Tech businesses, they trade on multiples of annual recurring revenue. And in general, recurring revenue or repeat revenue is so much more valuable to a purchaser than one-time revenue. because again, it just depends or kind of goes back to that concept of risk. So recurring revenue, it's much more likely to be there every year because it's repeat or recurring in nature. So you have much more certainty of, what you're going to achieve going forward versus having a lot of one-time revenue that you don't really know if you're going to get the same amount year over year, and it could make it much more volatile. The third point, what's the cash burn rate of the company, and does the company have enough capital to reach its next milestone? That's super important as well. Oftentimes, when I was in Maple Leaf Angels, you'd see angels coming together and pooling their funds because a company would demand a certain amount of capital to get to their next milestone. There's no real point for an investor to put in, too small of an amount into your business that it doesn't offer you the potential to advance, because they won't be getting return on that. Cash burn rate is really, well, how much runway do you have? How much cash are you burning every month? That if you didn't get more capital, how long would you have till you had to, retire your business or hang up your business? And that's really important just for your planning purposes to know, well, how much runway do I have? Do I need financing in the next year or 2 years to really sustain or to be able to support my growth goals? The next one is past financial information available, and if so, how do they compare against projections? With early stage companies, we often don't find a lot of past information available, or if there is past information, it's not super relevant. Again, we always have to consider it. And if you do have revenue that you've been generating already, it's good because it reduces the risk of future generation versus a pre-revenue company, and then all of a sudden you're projecting a lot of revenue growth. And then the third or the last point would be much more qualitative in nature. Again, how organized are the company's financials? Again, this kind of draws to how the management team is or how structured and organized the company is, and it really feeds into investor confidence again. And then the last factor to consider is really the stage of the company. So where a company is in its life cycle can determine which factors will have the greatest importance in evaluation. So generally, the earlier stage the company is, the more we're forced to rely on more qualitative factors, versus the more mature the company is, the more we can rely on quantitative factors or financials. Early stage companies, they are much more risky, obviously, because you haven't proven anything yet. But they do have higher upside if you are able to meet those goals. And for investors to buy in at, a relatively low dollar or low multiple valuation for a company that can experience a lot of growth can have huge upside. And it's always that kind of trade-off between risk and reward. The higher the risk you take, the higher the potential reward. The other factor is earlier stage companies. They're obviously farther from an exit event. It might be a bad thing for investors. It might be a good thing. So like with investors, no particular investor is the same. They all have their personal preferences. So you'll find even some group of investors might stray away from a business if it's too early stage, while others might jump at that business if it's early stage. So it really depends on the personal preferences of the investor group or the providers of capital that you're looking at. Okay, and then the last section I have here to cover is really what we're seeing with the pandemic in terms of our valuation multiples. So with the pandemic, it's caused a lot more uncertainty in our valuations, but again, this really depends on the industry. We've seen some industries really be resilient. Tech is a great example of an industry that continues to trade on really, really high multiples. And really hasn't fluctuated much because of the pandemic. So that industry has been a little bit sheltered, but in general with like manufacturing or retail, if your earning levels have gone down this last year, which we've seen a lot of it happen, it does have a little bit of a downward effect on the valuation multiples. Again, it's always good to think of your valuation in terms of risk. So if your past performance is volatile, that provides or presents more risk to investors. So your valuation will be lower if it's more risky. When you're trying to enter the market to sell, and we've had clients come to us looking to sell, my advice is wait till your performance rebounds if it has been affected by the pandemic, or at least wait till you have an interim period where you can say it's returning to pre-pandemic levels. because you don't really want to sell on a low. You want to sell on a high, or you want to sell kind of having the story that you're going to be trending upwards. So yeah, in general, valuation multiples have gone down, but again, it depends on the industry, and it really depends on your specific business and growth story too. I mean, some businesses have done well despite the pandemic, and then some, you know, like many have experienced lower earnings levels. In general, the private space, it still remains super, super competitive. There's a lot of M&A traction and a lot of private equity traction. The private space is still really competitive, and it's still giving investors a really good return. And then the last couple slides is my shameless plug of our video. So we are a national firm. We offer a bunch of different advisory services throughout Canada. Location doesn't really matter. I'm based out of Calgary, but I service Toronto and Vancouver and kind of all over Canada. And then in terms of industries, we really service the broad industry base. I specialize in tech, like I said, and some manufacturing, but we do offer valuation work in financial institutions, real estate, as well as retail and consumer businesses. And we are very mid-market focused still. Our clients, they do range from smaller owner-managed companies to the larger public ones, but really our bread and butter is helping entrepreneurs and smaller owner-managed businesses. Okay, so that's it. Are there any questions?
If anyone has any questions, feel free to put them in the chat box or in the Q&A box. And if not, you will get a copy of this recording sent to your email tomorrow. So if you can think of any other questions, you will have that recording coming to you. So I think we'll leave it at that if there's no questions then. So thank you so much, Megan, for explaining the importance of valuing your business. That was extremely helpful. And thank you to everyone that joined us today. As another reminder, you will be able to view this webinar on demand on our website by the end of the day tomorrow. And it is Financial Literacy Month, so we do have some more webinars coming up on those topics. Our next webinar is next week on Wednesday. It's business budgeting and cash flow tips. So if you haven't registered yet, please do so at west.ca/events. Oh, do we have one? Oh, Cash says, thank you for the presentation, very informative, so that's nice. So thank you again, Megan, for joining us, and have a great day, everyone.
Thanks, Emily. Thanks, everyone.